In less than 1 month, the S&P 500 has plunged over 8%, while the Nasdaq 100 has fallen even further by more than 11%, as confidence in the strength of the US economy continues to plummet for both corporations and consumers alike. Warning signs are flashing red across the financial landscape, and there are now several key economic indicators that have historically been very accurate at forecasting future recessions, which are now suggesting a financial crisis is around the corner. Donald Trump's aggressive tariff strategy has undoubtedly been the main catalyst for recession fears across companies and consumers alike, with 25% tariffs on imports from Canada and Mexico being imposed this month, as well as a 10% increase in Chinese import tariffs as well. Economists have warned that this escalation on trade policy could cost the average US household $1,200 annually in added expenses, and also act as a regressive tax that disproportionately affects lower income families who will have to pay more for everyday items. But it will also reduce the disposable income of everyone, which could have a big hit on consumer discretionary companies. We are already seeing the consumer expectations for business conditions, as well as the average weekly hours worked in manufacturing, both being the main components that are driving the Conference Board's leading economic index lower in January. And the Consumer Confidence Index is also now approaching lows that were not seen since 2020 and 2021 pandemic fears. All of this unpredictability has caused a lot of businesses to suddenly halt investment out of uncertainty of where the economy is heading, and some are even now coming out to issue warnings to investors. Target stock price dropped 5.7% following its latest earnings after it issued a rough first quarter profit warning due to Trump's tariffs on goods from Mexico, China and Canada, as well as weak February sales. And Target CEO Brian Cornell did say that its shoppers would likely see price hikes in its stores over the next couple of days. Walmart also issued soft full-year guidance in their earnings call, blaming tariff uncertainty, while Best Buy are also warning about tariffs impacting their results, which did result in their share price to drop by 15% on the day. And Delta Airlines CEO also warned that economic worries among consumers and businesses were already hurting domestic travel, stating, "Consumers in a discretionary business do not like uncertainty." And it's not just consumer-facing companies who are sounding the alarm on a recession either, as we are also seeing banking giant JP Morgan's chief economist Bruce Kasman raise the risk of recession to a 40% chance, up from 30% at the beginning of 2025. And this does come with a risk of lasting damage to the country's standing as an investment destination if the administration undermines trust in US governance. Now, Kasman also added that the risk would rise even higher, probably to 50% or above, if reciprocal tariffs that Trump has threatened to impose from April were to meaningfully come into force. And economists at Goldman Sachs and also Morgan Stanley did join JP Morgan's increasingly bearish view on the US economy, downgrading their US growth forecast last week, now seeing growth at 1.7% and 1.5% this year, respectively. And also, 95% of economists that were polled by Reuters last week across Canada, Mexico and also the US did say that recession risks in their economies had increased as a result of Trump tariffs. But the yield curve is perhaps the most obvious signal that is flashing red right now, warning of an imminent recession, and we've just seen a 27-month period of it being inverted, the longest cycle in modern history. This is not only a very reliable recession indicator that has not been wrong for 60 years, correctly predicting 8 out of the last 9 recessions since 1960, but the chart is also looking eerily similar to what happened in the run-up to the 2008 global financial crisis. The yield curve inversion of 19 months between 2006 and 2007 is the time which saw the second largest period of time of yield curve inversion, which preceded the severe economic downturn of the 2008 crisis. But the 2008 recession didn't kick in immediately after the yield curve normalized. There was a time period of about 8 months after the yield curve normalized, and history does suggest that we do normally see a delay from anywhere between 6 and 12 months. The current yield curve normalising after an even longer period of time than what we saw pre-2008 is a very scary signal indeed, as it does suggest that we could enter a deep recession period later on in 2025. And those who believe that this time is different and that the yield curve recession indicator will be wrong about predicting a recession this time around are suggesting that a historically reliable indicator will be wrong for the first time in 60 years. We all obviously hope that this is the case and that the indicator is wrong, but unfortunately there couldn't be a stronger indicator right now that an imminent recession is on its way. Now, during these times of uncertainty, we're seeing more and more investors, institutions and global central banks flock to safe haven assets like gold, an asset that typically outperforms during market downturns. Now, the price of gold briefly reached $3,000 per ounce last week, and it has seen a whopping 38% price increase over the last year, with 13% of these gains coming in 2025 alone. Now, with tensions between Ukraine, Russia and NATO escalating over the past month or so, now becoming more and more messy in terms of what the plan is, gold's status as a reserve asset has only been enhanced. Now, Trump's tariffs are also contributing a lot to the price of gold rising as well, as we are seeing a weakened US dollar, increased inflation concerns, as well as increased overall economic uncertainty, which are all factors that push investors towards gold. Now, surging gold prices is typically a signal that a recession or an economic downturn is coming, and this can clearly be seen in the price action during the global financial crisis in 2008. So this price action that we have been seeing recently is a significant indicator that investors believe that things are soon about to get rough. Now, we do also know that the average US consumer is not in a strong place right now, and that's even before we see Trump's tariffs really start to take effect. And there are many metrics that point to many households really struggling financially right now. Consumer spending, which drives around 70% of US GDP, has started to show alarming fragility, with January 2025 seeing a decline in retail sales, auto sales and also housing activity. We're also seeing consumer credit card debt continue to rise, the savings rate remain pretty low relative to the historical average, and also housing costs staying extremely high, with people on average spending a higher percentage of their income on their mortgage or rent than what we have seen for multiple decades. The unemployment rate has also ticked upwards from the lows that we saw of 3.4% in 2023 to now being at 4.1%, and the problem is, this number is threatening to go higher. This is not only because of business uncertainty that is going to lead to less new hires being made, but also there could soon be a tidal wave of public sector layoffs from the government. Now, this is thanks to Elon Musk's Department of Government Efficiency, also known as DOGE, in an initiative to trim waste from government spending and to also overall streamline operations. Now, this initiative aims to implement sweeping layoffs across federal agencies, which could potentially lead to one of the largest job cuts in US history, and we have already seen approximately 62,000 federal employees get laid off so far. And analysts do predict that the total layoff figure from this restructuring could reach a staggering 300,000, which would surpass major historical mass layoffs like IBM's 60,000 job cut in 1993 or the Lehman Brothers layoff of 25,000 people in 2008. Now, in the long run, this may well end up being a net positive thing for the US economy, with government spending becoming more efficient. However, in the short run, we are looking at a significant mass layoff event that has never really been seen before. The consequences, therefore, in the short run could be quite devastating, not only for those losing their jobs, but also the trickle-down effect that this could have on other areas of the economy. Now, I touched briefly on the housing market, which in itself looks to be a massive storm brewing for the economy. Now, affordability is at an all-time low, and there could soon be a tidal wave of new supply hitting the market, which could only exacerbate any market correction that may happen, and ultimately could mean that a full-on housing market crash does take place. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, please do leave a like on the video and subscribe if you enjoyed it. That does really help out the channel, and thanks a lot for watching.